Hello, I'm Winnie. Today I will talk about the Coca-Cola Company financial analysis. First is the balance sheet from Coca-Cola Company and all the number and ratio based on Yahoo Finance from 2020, and I post the 2019 number and 2018. Also, this is the income statement and addition data, and this number are from Yahoo Finance and Microtrends. Okay, let's talk about the vertical analysis. For the balance sheet of the Coca-Cola Company, it is clear to see that the percentage of long-term assets higher than current assets, and goodwill taking the largest proportion in the total assets. Inventory is the smallest percentage that taking total assets in 2018 and 2019, which means the Coca-Cola Company does not have too much inventory. And about vertical analysis in the income statement, and the gross profit taking the biggest number in the revenue. That means this company is highly profitable. Compared to the 2018, there's no very huge difference in balance sheet and income statement. That is proving assets, liabilities, or net income remain at the same level. Also, the Coca-Cola Company should focus on long-term debt. It is taking the largest percentage in the liabilities. This means that the company needs to pay its debt in a long period. The next one is horizontal analysis. The horizontal analysis is using 2018 and 2019. Obviously, most of the current assets decreased in 2019 and almost long-term assets increased in 2019, especially the investment and advanced and other non-current assets. This may represent that the company has spent money to buy long-term assets and support its operations. For the liabilities, most of the liabilities grew up. It means the company has more debt in 2019 and the company did not pay back some liabilities. The Coca-Cola Company have to pay attention to the liabilities. Next, every number is increasing in the income statement in 2019 except the other income or expense net. This is proof that the Coca-Cola Company has a great value in turnover. So we can start to talk about the ratio analysis. Firstly, the liquidity ratio. I would say the Coca-Cola Company does not have the ability to pay back their debt. Working capital and current ratio are measured short-term debt paying ability. However, we can observe that the working capital is a negative number, and current ratio is less than 2. 2 is a golden rule for the current ratio, and it is same phenomenon happen in quick ratio. We can see quick ratio is 0.56, and this is half the golden rule, which is 1. Therefore, the Coca-Cola cannot pay back their debt. Inventory turnover measures liquidity of inventory, and higher inventory turnover leads to fewer days sales in inventory. Obviously, Coca-Cola Company does not have a high value in inventory turnover. For the company, it is taking the company longer to sell the inventory, and consequently, there is a greater chance of inventory obsolescence and higher carriage costs. The receivable turnover is approximately 10. It is the normal number. Based on this number, we calculate collection period. Mostly the collection period within 30 days is a good number. And in this company, it takes 36 days, which means the Coca-Cola Company collects account receivable in approximately 36 days. The next one is solvency ratio. Solvency ratio measures the ability of the company to survive over a long period of time. In this case, we can understand the Coca-Cola Company is more relying on debt financing based on debt to total asset ratio The proportion of debt to total asset ratio is 75% and it is higher than 15%. That represents the company has been aggressive in financing its growth with debt. Then we calculate the interest coverage, use net income plus interest expense plus income tax expense and divide by interest expense. At last get the number nearly 12. This number is measuring ability to meet interest payment. The lower the interest coverage ratio, the higher the company's debt burden and the greater the possibility of bankruptcy of the default, and the higher ratio indicates the better financial health, as it means that the company is more capable to meeting its interest obligations from operating earnings. I would say the Coca-Cola Company have a good free cash flow, which is $1.4 million. It means the company developed new products, buy back stock, pay dividends, or reduces debt. So at last, the profitability ratio. Let's jump to the profitability ratio. Firstly, the gross profit margin is up to 16%. Normally, 20% is the perfect number in gross profit margin, and it proves the company's profitability is great. So, as higher margin means that there's more available to invest, save, or cover indirect expense. It represents what percentage of sales has turned into profits. Simply, the percentage figure indicates how many cents of profit the business has generated for each dollar of sale. For instance, the Coca-Cola Company is achieved 20% profit margin during the last quarter. It means that it had a net income of $0.2 for each dollar of sales generated. Turning to the asset turnover, the higher the asset turnover ratio, the more efficient a company is at generating revenue from its assets. The Coca-Cola Company only gets 0.44, so this shows that the company operates efficiently. Based on ROE and ROA. High ROA is the telltale sign of solid financial and operational performance. However, the number is only 1%, so the company might have over-invested in assets that have failed to produce revenue growth. ROE in this company is bad. The ratio is 4%. This means sales much less net income is generated per dollars of equity shareholders. Let's talk about earnings per share. A company with the high earnings per share ratio is capable of generating a significant dividend for investors. Or it may plow the funds back into the business for more growth. And it is $2 EPS in the company. This is a normal number to the Coca-Cola Company pays normal dividends to investors. In the end, price-earning ratio is only 0.02. Generally speaking, the high price-earning ratio indicates that investor expect higher earnings. However, a stock with the high price-earnings ratio is not necessarily a better investment than one with a lower price-earning ratio, as a high price-earning ratio can indicate that the stock is being overvalued. Therefore, it may represent smaller the investment risk of the stock, the more worthy of investment. So overall, I would say in the Coca-Cola Company is not liquid based on the working capital quick ratio and current ratio. So this means the company does not have ability to pay debt. And based on the solvency ratio, I would say this company relying more on debt financing, and also they have a good free cash flow. At last, although they have a high gross profit, and they also have the low ROA, ROE, and asset turnover, which means at this time it's not a good time to invest this company. But by the contrast, it also tells us it's smaller the investment risk of the stock. So that's all. Thank you for listening.